All right, let's talk about one of the biggest, most ambitious corporate makeovers happening right now. I'm talking about Siemens. We're going to dive deep into how this old-school industrial giant is betting the farm, really, on a digital, software-driven future. And what that all means is fascinating.
Yeah, I know what you're probably thinking. Siemens, right? Heavy machinery, classic German engineering. And you're not wrong. But that's just a tiny piece of the puzzle now. Seriously, this isn't your grandfather's Siemens. They are fundamentally changing who they are from the inside out. So, what's this all about? It really comes down to one word: a pivot. A massive, deliberate pivot. They're shedding the skin of being this, sprawling, do-everything industrial conglomerate, and they're laser focusing on becoming a true tech titan. And the master plan behind all of this? It's a strategy they call Vision 2020 Plus. The idea itself is pretty easy to grasp, but putting it into action? Whoa, that's a whole different story. It's all about simplifying the business and going all in on the biggest trends out there: digitalization and sustainability. Think of it like this. They're trying to build a bridge between the real physical world of machines and the digital world of software. Now, you might be thinking, okay, big talk, but are they actually doing it? Oh, yeah. This isn't just some fancy mission statement hanging in a boardroom. They are absolutely putting their money where their mouth is. Just look at these moves. In 2020, they spun off their entire energy business. That's huge. Then, they sold off a big traditional motors business for 3.5 billion euros. And what did they do with that cash? They turned right around and announced they're spending over 15 billion euros on cutting-edge software companies. You don't make moves like that unless you are dead serious about changing. Okay, so after all that shaking things up, what does the new Siemens actually look like?
Well, you can basically break it down into 4 main pillars.
All right, first up, you've got digital industries. This is really the new tech heart of the company, all about automation and industrial software. Next, there's smart infrastructure. This piece is all in on the energy transition, so think smart grids, super efficient buildings, that kind of thing. Then you have mobility, which is exactly what it sounds like: high-speed trains, rail automation, all things sustainable transport. And last but not least, Siemens Healthineers. Now, this is a separate company on the stock market, but Siemens still owns 75% of it, and it's a giant in medical tech. So there you have it. That's the new map of Siemens. Okay, but here's where the plot really thickens. If you want to understand what's really going on with Siemens right now, you have to get this one key thing. There's this internal tug-of-war happening. It's like a tale of two companies, both operating under the same roof. Two totally different stories playing out at the exact same time. You'll hear investment analysts use this fancy term, a bifurcated narrative. I mean, that's really just a $5 word for saying that different parts of the company are going in completely opposite directions. So here's the breakdown. On one hand, you've got that super important high-profit digital industries division. And right now, it's sailing right into a storm. Its customers, particularly in China, are hitting the brakes. They're not ordering as much automation gear because, well, they already stocked up a ton during the pandemic. But then you look at the other side of the business, smart infrastructure and mobility, they are absolutely booming. They're sitting on these massive backlogs of orders fueled by huge long-term trends. We're talking the energy transition, the insane growth in data centers, and the big push for green transportation. So you see the split, right? One side is struggling with a short-term cycle, while the other is riding these huge long-term waves.
So that begs the question, right? How on earth can a company pull off this kind of epic transformation when one of its main engines is kind of sputtering? Well, the secret weapon is its incredible financial strength. And when I say incredible, I mean it. Get a load of this. Even with all those challenges we just talked about, Siemens generated a jaw-dropping 10 billion euros in free cash flow last year. 10 billion euros. That's the kind of financial firepower that lets you not only survive a storm, but also place these massive game-changing bets on your future. And you can actually see this tale of two stories playing out right here in the numbers. It's fascinating. Just look at the profit margins. See digital industries? The margin shoots up to a massive 22.6%, and then it falls back down. But look at smart infrastructure during that exact same time. It's on this beautiful, steady climb, nearly doubling its margin. It's like you're watching that internal tug-of-war play out in a spreadsheet. Pretty wild, right? And hey, don't just take my word for it that they're financially solid. The big dogs in the credit rating world, Moody's and S&P, have both given Siemens an upgrade. They're basically saying, yep, this transformation seems to be working.
On top of that, the company keeps giving more money back to shareholders through dividends, and they just announced a new €6 billion share buyback. You don't do that stuff unless you're feeling pretty confident about where things are headed. Okay, so this all brings us to the billion-dollar question, doesn't it? For anyone looking at this company, for any investor, it all comes down to this. With all these moving parts, is Siemens a hidden bargain right now? Or is its price tag actually fair considering all the risks? To really get into that debate, we need to talk about something called a valuation discount. It's a simple concept, really. It just means that the stock market is giving Siemens a lower price tag relative to its profits than it gives to its direct competitors. And the big question is, why? And this chart, it makes that gap totally obvious. If you look at this common metric, Siemens is trading at about a 15 times multiple. Now compare that to a competitor like Schneider Electric, a bit higher. But then look at Rockwell Automation, a big American rival. They're way up there at over 26 times. There is no doubt about it, the market is looking at Siemens differently. So this is where the big investor debate comes in. You've got the bulls, the optimists, who are pounding the table saying, the market is being way too short-sighted. Everyone's obsessed with the temporary dip in digital industries, and they're completely missing the incredible long-term strength in the other parts of the business, not to mention all that cash they're generating. But then you have the bears, the pessimists, and they say, hold on a second. That discount is there for a reason. They'll point to the very real risks in China's economy, and maybe most importantly, the enormous challenge of actually integrating all these multi-billion-dollar software companies they just bought. So what's the game plan to prove the bulls right? Well, it kind of boils down to a four-step mission. First, they've got to survive this current cyclical downturn. Second, they absolutely have to nail the integration of those massive new software companies. Third, they need to keep riding those big waves in data centers and green energy. And finally, if they do all that, they have to convince Wall Street that this new, tech-first Siemens deserves a much higher price tag. And that, right there, leaves us with the ultimate question. Can this 175-year-old industrial giant truly pull it off? Can they successfully stitch together these massive, multi-billion-dollar software bets to completely remake themselves and win the future? It is a huge, high-stakes gamble, and whether they succeed or fail, well, it's going to be one of the most fascinating business stories to watch for years to come.